presentation contains current opinions of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that those opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation.
Hello, everyone, and welcome to the Compak Market Wrap update for July the 6th, 2026. I'm Moe Javaid, President of Compak Asset Management, joined by Javaid Ansari, Executive Vice President, and we're going to talk about the markets, what happened last week, what to expect next week. Javaid, first of all, I want to remind all of you, quick housekeeping note, go to compak.com, click on Insights, and you can see all the episodes of this podcast and the YouTube update. Click on the subscribe button. If you do that, you'll be automatically notified when we post one of these updates. Also, if you need help with your portfolio, all you have to do is send us an email at invest@compak.com, or you can do it the old-fashioned way. Give us a call at 800-388-9700. Javaid, let's start with the numbers. Or before we go to the numbers, let's talk a little bit about Feroz's book, Wisdom and Wealth Solutions. Tell me a little bit about it.
We're getting closer. So release date's July 14th. We have a big event at UC Irvine here in Southern California on July 22nd. It's going to be a big book launch. We're going to have one of the largest auditoriums at UC Irvine filled. So if you'd like to attend that event, just shoot us an email at invest@compak.com and we'll go ahead and send you that invite. It's free. It's going to be a great event, not only for clients, but anyone that's interested in, I think, what is our core philosophy here in terms of wisdom and wealth, trying to understand. And just to give you a little caveat, Chapter 1, religion. Chapter 2, politics. So we hit the big notes right off the beginning, but it just talks a lot about what perspective that you can potentially have when looking at these different elements of life, and when you're really kind of trying to understand, okay, how do I go about building my wealth, and why am I building this wealth, and how you can really understand where you're at, what your concrete box looks like. And so if you'd like to learn more about these terms, feel free to just shoot us an email. And then I'm working with Feroz right now. We'll have a special YouTube edition on the Wisdom and Wealth here in the next couple of weeks, so stay tuned for that.
Yes, that's going to be a great event. It's going to be on the 23rd, is it?
22nd.
22nd of July. Mm-hmm. It's at the University of California, Irvine, in their business school auditorium, large auditorium. It will be packed. I will be there. So if you want to come by and say hello, I will be there. And it is absolutely free. But I think it's this book and the whole philosophy of money and how to handle money. That's really what it comes down to at the end of the day. Wisdom is great, but how do you combine that? I've seen a lot of wealthy people make a lot of money, lose a lot of money. They're on a roller coaster of life and wealth. How to avoid that roller coaster, how to build a stable life that makes you happy. That's really what this book is all about. So come to the event. It is free. I will be there. Javaid will be there. Feroz, obviously, the author, is going to be there. A lot of people from the University of California Business School are going to be there. There'll be a fireside chat about the book. It's all free. So come by. If you're interested, send us an email and we'll send you an invite so you can get the free tickets on how to come to this particular event on July 22nd. Let's start with the numbers, Javaid. S&P down slightly, sort of market biding time. That's the way I would look at it.
Yeah, I mean, we're up. S&P was up 1.78, Dow up 1.99. Russell, a little bit of a breather, down 0.42. IFA up 2.77. So really, since we've seen the de-escalation in the Middle East and oil prices have come down, we've really seen a reinvigoration of the kind of like go global trade, which we saw a little bit earlier this year. It took a breather when we had the bombing in Iran. But IFA was up 2.77 last week, now still outperforming the S&P year to date, up 11.71% year to date versus S&P only up 9.98. I say only up 9.98. We'll take that given the last couple of year of returns. Emerging markets still up 1.04, and then the NASDAQ up 2.12. So overall, I think we kind of had that pullback in April, May, but now that things have recovered, we've really seen a rotation out of some of the bigger stocks. I look at an equal weight index. RSP is an ETF that tracks basically equal weighting all of the S&P 500 constituents. That's been tangibly outperforming The S&P, which is more weighted towards the technology stocks, since the middle of June, it's up almost 6%, whereas the S&P is kind of flat or so since the middle of June. So for me, that's a really good sign. When we have that rotation, it's kind of broadening out some of the returns. High yield and all of that, we'll get into some of those charts. They're still very strong. So overall, things are still looking pretty good.
It was a good week overall. That's the way I would look at it. And this is what really puts it in perspective. It's broadening out. It's not just technology. Technology was way down. When you look at the numbers, way down to only a 0.09% for the week. And we saw communication services, which is also technology.
Yeah,
that was
Google.
but financials were up, consumer discretionary were up. We saw healthcare also up. So it was a broad market advance that we saw, not just technology on the top pulling everything along with it. Energy obviously lost a little bit. Real estate down because we saw a little bit of a jump in interest rates, and we'll talk about that later on. Oil down to where it was just about at when the war started.
Yeah.
That's where it is now. I mean, gasoline prices have not come down. Oil prices have.
Yeah, the gasoline prices have come down a little bit. Oil prices have come down more. We're going to have some charts in the update this week that really kind of dive into the core or the connection between oil prices in terms of WTI, Western Intermediate Crude, versus actually the prices we see at the pump. And those two things have a lot of different elements built into them. We're going to dig into that today.
Yeah, when oil prices go up, gasoline prices go right up. When oil prices come down, gasoline prices do not come right down with it.
Correct. And so that has a lot to do with distribution and all of these different margins. So let's come in.
What's wrong with that picture? That's what I want to know.
We'll show you some charts here. Once again, if you're listening on the podcast, always feel free to just tune in on the YouTube channel. You just go to compak.com/YouTube, and you can be directed straight to the YouTube channel. You can see all these charts that we'll talk about.
Look at this. 1 week, 4.38 last week. This week we're up 4.4
on the 10-year Treasury. So we're talking interest rates here. And so, aggregate bonds were down 0.5% last week. I think, once again, a good time to buy. They've kind of already come back since then. But high yield up 0.29%. So as long as that high yield chart continues to go sideways to trend up, it's all good. And then I think when you do see these little fits and starts around oil or just around interest rates, I think that is a good opportunity to maybe upgrade your portfolio. Like I've been saying all year, move some of that cash, which a lot of people seem to have, moving some of that cash into the bond market whenever you see these spikes and take advantage of those high rates.
I hear all of this all the time. Can't go any higher, the market. Oh my God, it's at an all-time high. I can't buy it. But for 5 years, it's been making all-time highs. If you're sitting and waiting and waiting and waiting, you've got a problem. So, if it's at an all-time high, and we've shown those charts that if you buy the market at an all-time high, you're better off.
Yeah, because
5 years later,
momentum's in your
favor.
We don't want to buy the stocks when they're going down. Of course, you want to always be buying stocks. I think is the rule of the thumb. Is the general rule is that the more wealth is created by buying stocks and real estate. You work hard, you save money, and you buy stocks and real estate. These are investments, passive investments that appreciate over time. Yes, they go through cyclical cycles. Will they have less return maybe going forward because they've had such great returns over the last couple of years? Maybe, but the key thing is they're going to have a return. And they're most likely going to have a return higher than cash. There is volatility associated with that, so you got to know your risk tolerance, and that's what we're guiding you here at Compak. But once again, don't be afraid of these highs. I think particularly if interest rates, we'll talk more about oil. I think we'll talk more about interest rates in the update this week. But if we continue to see oil prices kind of drift lower, shelter prices and everything else has been kind of drifting lower, I think that puts downward pressure on interest rates. I think the market's already anticipating that. That's why the market is at all-time highs or near all-time highs, even though the valuations are high. But if that interest rate environment remains rather tepid in terms of going sideways to down, that allows the high valuations of the stock market to be, supports those high valuations. You're not going to see that big
I've talked about that. Like 3 weeks ago, everybody was talking about, we're going to get interest rate increases. We're going to get the 2-3 interest rate increases by the end of the year.
Well, that's what they're anticipating. I think 1.5%.
Yeah.
Or 1.5 hikes, maybe 0.7%, 1% increase in interest rates by the next year.
And I said, and what did I say? I said, I don't think so. I think this inflation is transitory. I know this word was used by Powell, transitory in 21, and said inflation is transitory. It wasn't. But I think this time it was a spike in inflation because of gasoline prices going up. And if oil prices continue to drift lower, which they are now, to where I think all the other elements, all the other components of inflation are already on the downward track.
I agree with you in the U.S. And so this is actually one of the things I was tracking last week. I was looking at Japan's PPI. We were talking about the yen, right, is at a 40-year low. So if you've never been to Japan, book a ticket because now's a good time. Ticket's probably a little expensive, but once you get there, it's going to be cheap. But, you look at Japan's PPI, it's at 6.3% in May. And you're seeing that Japan rate, Japanese rate it's at record highs, the 10-year yield. It's still not very high. I think it's only at a couple of percent, maybe 1.5%, 2%, because Japan's been having a lot of deflation. But it's one of those markets that I'm just watching really closely because of the amount of debt that Japan has. If their interest rates continue to go higher, that could be a little bit of the canary in the coal mine around all of this sovereign debt. And so it's just something to be aware of. Right now, Japanese stocks are doing well because their currency is being depreciated, and so then that does well for exports and et cetera. But it's just something to kind of watch, and I'm watching that closely. We're getting not a lot of data this week. We'll get some information on global inflation, but I think the U.S. is increasing productivity. We had the jobs number last week. Wasn't great.
Yeah, it showed that only 57,000 jobs were created. It was about half of what was expected.
Yeah.
But the unemployment rate came down.
Yeah.
4.2. Everybody said, "Oh my God!" It's not because it's just people are stopped looking for work. That's really what happened as far as that goes.
Yet the GDP growth is still there. So when you have lesser people working, but you still have the growth, that means productivity is still at highs and is expected to continue to go higher with the implementation of AI. You're not quite seeing quite that amount of productivity gains on other parts of the world. And so then that gets a little, it would be interesting. I think that it kind of just goes back to, yes, global is kind of doing, I think, in line with the US, but it's just, I think, something to watch as we continue to see here going forward. I'm not worried about inflation here in the United States, but there does seem to be a little bit more inflationary pressure, particularly with Japan. They have to import all of their oil.
Yeah.
Right? So if oil prices they've come down from being really high, but if they even come down just a little bit, it's still much more inflationary than where it was last year for them.
This is memory chip stocks. I mean, they've been just going on a skyrocket, Micron and companies like that, and their profits are going through the roof.
Yeah, I mean, I think that the question is are we in a bubble?
Right.
And I don't think we're in a bubble. But we're in high valuations, and then particularly look at these margins. I mean, going back for the last 20 years, margins for these type of software memory chip companies were always averaging around 10 to 20%.
Right.
Now the forecast is 50% because of all this AI build out going forward. So that's a tangible, different type of secular change that we haven't experienced. Now, we didn't have AI for the last 20 years. And if AI is really going to be, which I do think it is going to be revolutionary, and I think it's going to cause a lot of disruptions for work, for people, humans specifically, does that mean it's going to cause a lot of negativity for the stock market? I don't know yet. I think maybe companies can benefit and they can experiencing higher margins, and that's what we're seeing so much. But I think this really dovetails into we're not going to get much economic data here over the next 2 weeks. I think we really have to kind of start to look towards earnings, which is going to really kick off on July 14th with JP Morgan, Citi, the big banks. They really kick off the earnings season. We'll then kind of see the earnings expectations have never been higher. They've been continuing to go up. Well, the earnings need to be spectacular, and I think they will be really good by all these profit margins and all these other things. Yeah, at least for these companies.
And these are just memory companies.
But the guidance needs to be just as good.
I know, and they're coming up with these numbers, and they're guiding that their profits will continue to rise. And as I've always said, the more money a company makes, more profitable a company is, the higher the price goes of their stock. The value of that company goes up. So these margins are just unbelievable. From 20% or 30% was the high, right here, to 70% is projected.
Yeah.
That's somewhere by the third quarter of 27. That's next year, another year of profit increase right here. And then it peaks and starts to go down, is the expectation. We'll have to wait and see what happens. But as long as these profits continue to pile up, I think that justifies some of the pricing.
Well, and I think it depends on, the margins are going to eventually come down, but I think it depends on how quickly. If you look at some of these peaks in the past, they're very kind of, at least in 17, they're very kind of very sharp peaks, right? And so you kind of have more, if things just level off and they're going to be 40, 50% margin businesses for the next couple of years, that's why the prices have gone up so much. And I think that's sustainable given the AI build out. Now, is there money to be made on these stocks and everything else? They've gone up a lot in a short amount of time. We'll see. I think the key thing to really understand is whether it's really sustainable going forward or if it's just a fad. And I think right now it's still looking rather sustainable. I'm not getting any indications from the market that things are going to necessarily go away. Doesn't mean there's going to be great investments on these stocks if you buy them today. But I think the key thing for all of our listeners to really understand is these seem to have bubble characteristics, right? About how quickly they've moved. But if you look at it underneath, it seems to be some sustainability around, the earnings for a period of time. And so, that's a good thing.
And I've said that for the last couple of years again. The difference this time around in these prices of stocks that have gone up a lot is these companies are making money. The difference in .com was none of those .coms were making money. They were expected to make some money sometime, some in the future, but they were all losing tons of money. The difference is these companies are making money, except SpaceX, which is not.
Or even OpenAI and Anthropic, and I think that's why OpenAI and Anthropic are like, let's see, and we'll see exactly whether they're going to IPO later this year. But I think for the meantime, we'll get the next big movement is going to be in July, later this month when we start to see earnings.
This is the chart we were talking about earlier. This is the oil price is in orange. It spiked up. It took off. It started in February. Took off right here. But the gasoline prices also followed. This blue line is gasoline. Oil prices came down with each ceasefire announcement, but then it went back up. Then it came all the way down. Now we're here, which is just about right here. If you look at that, and that, we're about the same price, slightly higher than where we were at the beginning, before the beginning of the war, or at the beginning of the war. We are right there. But gasoline prices are still up here. There's a big difference here. And why is that? I mean, oil prices have come down. Why have gasoline prices not come down?
Well, it's this second chart. And so I always like to it depends on, basically the bottom line is it depends on where you live in the country. All of the manufacturing or the refinery capability for the most of the United States is in Texas and Louisiana. So the further you get away from Texas, Louisiana, Oklahoma, the more you're paying a distribution premium. So you think about California, Washington, Hawaii, Alaska, they're the furthest from those distribution points. So they're always going to pay higher prices because of that. Also in California and Washington, there's a big sales tax on oil. There's a lot of additives, so there's additional tax that you have to pay. But I think the key thing is we look at national oil prices, not just, if you live in these further away from the distribution points, you're always going to pay higher oil prices, and that's always been built in. But I think the key thing is to look at the national oil price. And right now, a gasoline price. And right now, national gasoline prices are below $4. It's about $3.90. And I think anywhere below $4, we're in a safe place. It's not uber cheap like it was clearly. Really, you have to go back before the Ukrainian crisis, Ukrainian invasion in 22, when we had really, even during COVID, clearly there was a lot of cheap gasoline prices. People weren't going anywhere. But since 22, oil prices have been higher. I think it's sustainable, but I think since the oil price has now come down, gasoline prices will continue to come down, and that will put more deflationary pressure or disinflationary pressure on the market and interest rates. So that's all a positive thing.
Payroll, we mentioned 57,000 jobs
Mm-hmm.
created. I mentioned that. That was about half as much as expected.
Yeah.
Unemployment rate went down to 4.2. That is because we saw a lot of people just giving up looking for jobs. But the manufacturing PMI went down to 53, but that is still above 50. Above 50 shows that we're expanding,
Yep.
we're growing. Below 50 is not good. So 53.3, it was down a little bit, but still positive overall.
Yeah, I think economically, job market, GDP, manufacturing, everything looks very much in a slightly positive orientation or imbalance. Stock market, it's pricing in a lot of exuberance around these earnings, but we'd rather have exuberance around earnings because that means that everyone's expecting the earnings to be there.
Right.
We'd rather take that than expecting the earnings not to be there and we're in a recession. So yeah, if we don't meet quite that exuberance, the market's going to bounce around. That's to be expected. But overall, I think when we're talking about investing, the key thing is to really kind of gauge the health of the economy and the labor market, and it seems rather
Everything is
healthy.
okay.
Yeah.
Not a lot of data coming out this week. We saw the non-manufacturing came out 54, just about as expected. We are looking at international trade balance. That doesn't
Just
matter.
nothing.
Yeah, it's just nothing this week. Very, very short week as far as data is concerned. Technically, here's the S&P daily chart. We completed the fourth wave, and as I've said, the fifth wave targets are somewhere around here, 7,800 or higher. So this is wave 3. Wave 4, we break out above here, the all-time high that we made at the beginning of, when was that, June?
Beginning June.
Yeah, it took off, and so I'm looking at 7,800
Yeah,
somewhere.
the all-time high, I think the intraday high was 76.20.
Right.
And one of the key things I'm watching, I think we are headed to new highs, which is great, is just going to be also if we see any sort of relative strength weakness, so divergence. So, we had really high relative strength back in June.
Yeah.
If we make new price highs,
Right.
but we see relative strength divergence, meaning it's not quite as strong a move to the upside, that can be a little bit of a sign of an exhaustion. And we kind of, it kind of then might dovetail with the weekly charts, which is telling us we're in those
And
fifth
that
wave.
might be if we make a new high, but the RSI does not go to a new high.
Correct.
That's the relative strength, and that's called a divergence. And with a fifth wave top, that might be something to
watch out for. So I think that's what we're going to be definitely monitoring here over the next couple
It
of
could
weeks.
be a couple of months from now. That's
Yeah.
what we're looking at. And the weekly charts are already seeing this 5 could move over here once we make a new all-time high, but we're looking at fifth wave tops.
Yeah, I think on the weeklies. So it's just saying, we want to hold as much beta as we can for as long as we can. But I wouldn't be, backing up the truck here. Some people, like I said, for putting their entire Roth in SpaceX, that is not the play. You want to just make sure you're well diversified. You're still invested,
But you have the right balance.
but you have the right balance.
Because this is the time that you have to be careful when plus once we get into, this could be a couple of months from now that we see this fifth wave high, but we also get into the anxiety of the election coming
Well,
up.
you nailed it on the head. I was looking at these previous kind of just mini tops that we've had where we've seen some corrections going back to October of 25, and that led to the tariff tantrum in April of 25. And then you look at October to then basically February of this year when we had the Iranian conflict. Those tops, those kind of rolling over tops, it was about 4 months. 4.5 months that the market just kind of didn't really go anywhere, made some marginal new highs, but really went down to recharge its batteries before it could make another tangible push to new highs. I think we're kind of in that same environment. And so if we look at, the first kind of high point was in basically beginning of June, you fast forward 4.5 months, that takes us right on the eve of the election. And so then I think some of that anxiety might start to play into this. I don't think it changes the trajectory of the economy or the stock market, but it could be one of those catalysts for some volatility like we've seen in these previous 2 pullbacks over the last couple of years.
NASDAQ, again, fourth wave completion, came exactly to the 50-day moving average, which is this blue line, came and kissed it, took off from it, broke it here, but came right back up, gap down. That was a concern. But here we are heading to new highs. Again, if we can get above here, which is around 27,200, we are at 26,100 today. We need to get above And
But it doesn't
push.
look like it's the leader, right? You're seeing other things like
Exactly.
relative strength. I mean, sorry,
S&P.
equal weight. The other 493 stocks, right, in the S&P. We're seeing small cap and even international. They're all outperforming a little bit of the Nasdaq this year. So, it's just something. Diversification. I think you don't want to necessarily be getting too conservative. But I think diversification is really that first line of defense that you really want to be making sure you have it very much in place, and you're making money through the diversification. So that's even better.
Right, so that's the weekly chart. Here's small cap. It continues to go higher. And it doesn't show the fourth wave pullback yet.
Yeah.
And so we could get somewhere if the S&P tops out over the next month or two, and then we could see a pullback here also. But this shows that it could come back up later.
Well, and just to caveat on the small cap chart, I think also small cap, the relative strength that we're seeing in small cap also aligns with the fact that we're potentially going to see lower interest rates. Small cap is traditionally much more correlated to interest rates. There's smaller companies, they have more debt. So if interest rates are going to come down potentially over time, that's a boost for the small cap. So the fact that small cap stocks are already kind of outperforming also kind of gives us a little bit of kind of inkling to say a little bit more conviction that interest rates are probably going to be somewhat stable to down potentially going forward.
Here's the international stocks. They've just been a nice, incredible run-up that we've seen here all along here. This is oil, continues to drift down the daily chart. We're getting close to the 200-day moving average now. Broke the 50-day, broke the 20-day, much below that. This is a third wave, fourth wave up, and then a fifth wave down.
Yeah, and I think the daily charts, are coming lower. I think the weekly charts are even more kind of interesting, where I think we're settling into a new higher range in oil. Not the super high range, but you kind of go back to where we were in 22. It got up to like 19 or 20 was kind of the high point. 19 is really the high point. And the low point of the range is really like 15 and a half. And then you go back before 22 is below 15 and a half.
Right.
So I think we're going to be in this 19 to 15 and a half type of range.
So
it's just kind of slightly higher oil prices than what we had before Ukraine. But nothing, crazy like everyone was worried about with the Iranian
somewhere
conflict.
around here,
Yeah.
this range right here.
And I think that's fine. I think that's just a
We
good
can live with
sign.
that.
We can live with that.
And the stock
It's
market
a
can
sign
live
that
with
there is growth.
Right.
I would think if we really saw oil prices tank from here, that's actually going to be a really negative sign, because that means potentially we're seeing demand really fall off a cliff, maybe particularly from China or from Europe. And that could just be a big headwind for the overall global economy. So I think oil prices, I don't think there's a lot of money to be made maybe in the energy markets per se. But I think we're just going to be, oil's been on everyone's radar because of Iran. Now it's kind of fading to the back, I think, a little bit. We're just going to settle into this range, and it's not so much of a market moving event like it has been over the last couple of months.
Interest rates sort of, this was the big top, come down, and now we're just sitting right around here, which is around 4.7, 4.8, 4 point, right around there. So I think we might, again, also in interest rates, just a little bit higher range.
Yeah.
Between 4.5 and 4.25, rather than where we are here, which was around 4%, 4.25 to around 4%.
Yeah.
So now it's a little bit 4.25 to 4.5.
And one thing I'm monitoring on the 10-year chart is we seem to be kind of narrowing in terms of the range. Right? You go back to some of the highs we saw back in 22. We saw the 10-year Treasury up to 5%, and then it dipped all the way back down to 3.5%. So that range has been getting tighter and tighter. So I do feel like, which is a good thing, that's why the market's doing well. But if we do break out of that range, we kind of temporarily got above it for a day or two there in May, right? Of those trend lines going back from those highs to where we were, and then you do a bottom trend line on the downside going up. But I think as the 10-year Treasury begins to really kind of coil,
right,
when it breaks out of that range, it's going to be interesting. And I don't know We don't know which way it's going to break out, to the upside or downside. But that could be something to really be cognizant of, because we said it last week.
Yeah, if interest rates spike
if interest
up,
rates move a lot either way,
it's not a good sign.
It's a very bad sign for the stock market. So as long as we're still in this tighter and tighter range, which I think can continue for some time, but I think you need to really monitor that range really closely. And once you break out of that range, you need to definitely sit up and understand why.
Here's the gold chart. It came all the way down here. It's bounced up a little bit from there, and we'll have to wait and see where it goes to. I mean, it came down here. We bounced up a little bit, but we're still way below the 200-day moving average, way below the 50-day moving average, and now we're just testing the 20-day.
Yeah, so it's lost a lot of momentum, right? So in order for it to really kind of gain back all that momentum, I think it's going to be tough.
It's a big downtrend in gold. That's really what the bottom line.
Maybe it finds a little bit of support here, but I don't see it headed up much higher.
Here we see HYG continuing to go up. We're also seeing AGG, but the spread, it came down. This is the spread between the two of them, the relative strength, and it came right back up.
Yep. So we've come right back up, and then once again, even though the regular bonds were outperforming AGG there for a week or two in late June, as long as HYG is still trending sideways to up, it's just the other bonds were outperforming because interest rates came back down from that spike. But as long as HYG is trending sideways to up, it's all good in terms of the economy.
Yep, and that's the way we're looking at the market. So nice week last week. We're starting this week on a good note. It was a holiday shortened week last week. I hope everybody had a great 4th of July.
Fun weekend.
Yeah, it was a fun long weekend, so everybody enjoyed it. I really like 4th of July also, even though Thanksgiving is my favorite holiday.
Yeah.
But because it's not too hot, not too cold, just right. And but the 4th of July, I really like the whole country sort of coming together. And with the World Cup going on, it's really got everybody together. It's a really nice feeling to see everybody sort of set aside all the political stuff and just have a good time and celebrate and all that we have, all the blessings that we have, and have gratitude for what we have and how fortunate we are to be here in the United States of America.
Absolutely.
Well, housekeeping note again, don't forget to click on subscribe so whenever we post one of these, you'll be notified. Go to Compak.com and you can go to Insights, and you can go to all the episodes of all of the podcasts there, and go to Compak.com/YouTube. You can see all of the charts that we talked about. If you need help with your portfolio, if you want to figure out, it's free, send us an email or give us a call.
And I would just like to add, I've had a couple of Compak clients. I know you listen to the weekly update, and thank you for listening. If you have any just general questions, I know specific questions regarding your financial situation, definitely reach out to me and your Compak team. But if there's, to all of our Market Wrap listeners, if there's any just general things you would like us to discuss on the Market Wrap, just shoot us an email at invest@compak.com. Say, hey, why don't you look at this market? What do you think about this stock or this sector? We'll be more than happy to dive into it right here, because I'm sure if you're thinking it, a lot of other listeners are thinking it as well.
Those are our thoughts, those are our observations, and we will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors, because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.